Does take us to our talk of the tape, the road ahead for stocks and your money. Let's bring in our experts. Liz Young-Thomas, SoFi's head of investment strategy. Cameron Dawson, chief investment strategist at New Edge Wealth, both here at Post 9. Christina Partsenevelos watching the sell-off in chips. That's dramatic. Seema Modi is all over the momentum names, which we already told you are under more pressure again. Steve Leisman looking at what all of this says about the current state of the U.S. economy. Liz, I'll just go to you first. Your feelings and thoughts as you watch this market being pushed and pulled all over the place.
I mean, it's chaos right now, right? We're in a chaotic environment. The market is obviously not calming down, even with the recent announcement literally just minutes ago that tariffs had been paused again until April 2nd. No relief, actually got worse in the sell-off. So I think the uncertainty and the fact that this now feels like we're just pushing off the decision until further into the future has everybody on edge. Not to mention, it's not just the market. It started to bake into some of the data. So we've seen the ISM data come in weaker. We obviously have this Atlanta GDP Now tracker that's come in pretty weak, which of course could change and reverse just as quickly as it went down. But the data, I think, is concerning, and we have to pay attention to that.
I mean, Cameron, the market is either going to need a chiropractor or a cold plunge by tomorrow because it's being pushed and pulled all over the place, knocked down, picked back up, then knocked down again. And all of this is really about what Liz said, right? A scare that the economy is slowing and slowing fairly quickly, and the uncertainty that comes with all of this.
We have seen some signs of growth fears starting to pick back up. The thing that we're watching the closest is credit spreads. Credit spreads will tell you how concerned we should be about further downside of the market. They're only up about 35 basis points off the mid-February low. They're still on the high-yield basis below 300. This is not an economy that is falling out of bed, according to the credit market. But I think we have to appreciate just how there was no margin for error in valuations when we started this year. Positioning was so very crowded. Valuations were so very high. So we don't find it surprising to see volatility. Our view for the year was wide and choppy range simply because you had no cushion to absorb any form of bad news.
Steve, I mean, this is an economy that is suddenly beset with a lot of uncertainty. You got it in the beige book, as you pointed out yesterday. You hear it from CEOs. You hear it from consumers. You see it through the data. You hear it from retailers and restaurants and other areas that are very sensitive.
Yeah, it's in the soft data now for sure, and it's in there in a hard way, but it's not yet in the hard data. We're bracing a little bit for the jobs report tomorrow, Scott. Right now, this morning, we had this 172,000 of layoff announcements from the Challenger Gray. You also have this talk anecdotally out there about the extent to which tariffs are causing people to not make certain decisions like buying, individual consumers buying things, and perhaps CEOs and CFOs not making certain investments. Got two threads out there. One is the chaos on the tariff front. Nobody really quite understands why they're doing tariffs. We got Lutnick on today saying we're doing tariffs on Canada and Mexico because of fentanyl, and then all of a sudden these tariffs are partially or somewhat, nobody even knows how much, have been taken back. And then the other thing, Scott, are these trade flows that are out there, these capital flows. You have this investment happening in Germany. You have stimulus in China. That is sucking capital away from the United States, making Germany and China both rivals for all of that capital that came here previously without a question. And that's another thing that puts stocks under pressure here in the U.S.
It's caused a level of uncertainty, I think, Liz, that people just did not expect. Right before the election, we highlighted numerous times on this network a piece that Greg Ip of the Wall Street Journal wrote with a headline that said the next president inherits a remarkable economy. On election night, when President Trump won, there was an overwhelming amount of optimism about what was about to happen for this economy and thus the stock market. And here we are, some 40 days in, and we suddenly have an uncertain economy. We suddenly have data that's showing softness. We suddenly have local Fed bureaus that are saying growth is going to fall by more than 2%. What happened? Where do we go from here?
Well, I think what's going on is what's been sort of attacked with a lot of this news is the exact thing that the optimism was based on. The optimism was based on a pro-growth, pro-cyclical, pro-U.S. environment And now here we are in the midst of a trade war that not only includes China, but other nations that I don't think we all expected it to include, and could even get broader reaching as the year drags on into Europe. So now we have growth fears in the U.S. We've got some labor issues in the U.S. that are showing up, as Steve mentioned, in some of this soft data. And we've got concerns over what companies might do. And my biggest concern right now is that the longer this uncertainty goes on, companies do have to adjust the way that they're planning for the year. They either pull back or they hit the pause button. They have to make cost cuts in order to adjust for what might happen down the road. And the longer this drags on, those adjustments continue to get bigger and bigger. They can't all just be reversed.